Welcome back to the channel, guys. I'm your host, Buckning, and today we are going to go through the balance sheet for Logitech as our continued series of reading financial statements or understanding financial statements. In the last video, we did go through the income statement, and this time we will be going through the balance sheet. And so if you're new to the channel, welcome. This is where we put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. And if you're not new, welcome back. So usually we purchase a position on Friday or increase a position, which the stock of the month for May is Qualcomm this month. However, we didn't have enough in the cash account, so we're just not going to make any purchases or anything like that. We will probably make a purchase next week because the current price is about $130 US. Because we're in Canada, there's an exchange rate, and it's probably about $150 that we need in there to make a purchase. So that is why we're not making a purchase this week. However, it fell in a good spot that we are going through and trying to help you guys understand financial statements. So there are three of them, which is the income statement that we did last week. Now we're going through the balance sheet, and the next one will be a cash flow statement. And after we go through the balance sheet, I'll show you guys what I look for when I'm looking at the balance sheet. But before we do that, we will go ahead and help you guys understand what is on there. So as you guys can see here, this is Logitech International. This is the company I'm doing my research on, currently doing my due diligence. This is what I mean by doing due diligence, doing my research. So the balance sheet is typically broken into three sections. So we have assets, we have liabilities, and we have shareholders equity. And typically on any 10K, it's broken into those three sections. However, Logitech has put liabilities and shareholders equity together, but usually it is broken into three sections. So we'll go through each section and what each line means and help you understand what it means and so on and so forth. But do understand that some 10K balance sheets or annual statements don't look identical. Logitech's balance sheet might look different than Apple's based on what they have listed on the line. So currently we'll go through assets, which are typically items that are cash or can be turned into cash very quickly. And that is typically what an asset is. An asset is anything of value or a resource of value that can be converted into cash. Okay. So that is what an asset is. So that is the definition. Okay. So current assets. So these are things within the next 12 months they will be doing something with, or something will happen, and we'll go through each line. So cash and cash equivalents. Cash is obviously cash, and cash equivalents are things like treasury bonds, some sort of vehicle that can be converted into cash very quickly, like the closest it can get to cash. So typically treasury bonds or corporate bonds, whatever it may be. So that is what that is, and cash is what they have in their bank account. So the total comes to $715 million, not $715,000, as you can see at the top, in thousands, except for per share amount. So add 3 more zeros to that, and that is $715 million. Okay, so that's how they typically write these out. They always put in parentheses or brackets what placeholders they're using. The next line here is accounts receivable. Accounts receivable is what money or cash is owed to Logitech by another company. Now, it's a short-term credit to the client, or sorry, yeah, for the client to pay not right away, but typically within the year. And that's what accounts receivable is. So in Logitech's account receivable, they should be expecting anywhere in that $394 million into their accounts from, sale of products, services, and so on and so forth. So that is that second line. Third part is inventories. This is stock that they may have on hand already, or within other stores, or at warehouses. So that is just of their product. So that is $229 million in inventories currently. The next line is the other current assets. So those are other assets. Typically, you can find what exactly that is if you go through the 10K. I'm not exactly sure because I'm just showing you guys how to read the balance sheet. Okay. So that is the first section of assets, which is non-current assets, which are typically things that can be converted into cash within the next 12 months. Next line here, as we scroll down, is non-current assets. So non-current assets is like your plants, your manufacturing plants, your equipment, anything of value in that sense. And so these are typically for the longer term. They're not for the short term. And so the first line here is property, plants, so manufacturing plants. When they say property, it's typically like a lease or a land that they have their manufacturing plant on or their warehouse on. And then equipment, there is value to that. And these things can be converted into cash if needed be, but they do play a part in the company operating. And so on the balance sheet, they have about $76 million worth of that stuff. Okay. And that is non-current assets. The next line here is goodwill. You'll see this on a lot of things, and a lot of people, this is where a lot of confusion might happen. So goodwill, how do I explain goodwill? So let's say, well, I'll give you an example. Logitech actually purchased a service company called Streamlabs. And let's say Streamlabs was, I think they bought it for like a fair value, it was like $100 million. Okay. But instead they paid $500 million. So Logitech paid $500 million for Streamlabs at $500,000. But fair value is about $100 million. I don't know who would pay that much, but usually it's whatever is on the company that they're purchasing, is balance sheet or what they're worth. But let's say they did buy for $500 million. So the company is worth $100 million, the Streamlabs, and they paid $500 million. So in goodwill, they put $400 million as goodwill because that was how much extra they paid for the company or acquisition that they wanted to complete. I know in 2019, I did look a little bit into it. The goodwill of $343 million was $343 million above a company called Blue, which produces mics. I think a lot of people have these Blue Yeti Snowball mics. And so that is what goes in goodwill. It's not a random made up number. It's actually a number that means something when it comes to these companies purchasing other companies. Okay. And other intangible assets. So these are like, what are those license, like, I forget what it's called. I'm drawing a blank, but these are like patents. So other intangible assets are like patents, like a special design on their mouses, a special design in their keyboards. They have some sort of patent on their product. Okay, that's what other intangible assets could essentially be. It could also fall under other assets. So this comes in at 126 million, almost 127 million. And then in other assets, you have 345 million. This could also be some sort of investment. And so, yeah. So that is the assets portion. Current assets are things that can be done within the next 12 months. Non-current assets are things that can be turned into cash, but are not because they are being used for the long term. And I'm talking, when I say long term, always the next 5-10 years for the company's operations. And so we have a total number of assets in 2020 sitting at $2.3 billion. Excuse me. Okay. So next section is liabilities and shareholders equity. So usually liabilities is separate. They don't, a lot of 10Ks, they keep it separate just to break it down. And again, when it comes to the sub list in these categories, some balance sheets will look different than this one because they have other liabilities and so on and so forth. So if you have maybe not understanding what a line means, you can take a look into it and figure out what that means. But we will go with a simple one like Logitech. I didn't realize it was this simple, but current liabilities are things that have to be paid within the next 12 months. So the opposite of current assets, these are things that need to be paid in the next 12 months. So accounts payable is the opposite of accounts receivable. These are maybe accounts that Logitech owes money to in the short term. So in the next 12 months, they have to pay out $259 million, maybe to raw material companies that help produce the plastics, chip manufacturers for maybe the chips that they use in these, if that makes sense. So they still have to pay money to other companies as well, and that is called accounts payable. So they currently have accounts payable of $259 million to other companies. Of course, that is a liability. A liability is something a person or company owes, usually a sum of money. Liabilities are settled over time through the transfer of economic benefits, including money, goods, and services. So the opposite of assets, that's essentially what it is. Accrued and other current liabilities, an expense that a business like Logitech has incurred, but has not yet paid. So it's not accounts payable, it's other things like obligations, benefit plans, those sort of things. That's typically what it is, or it's periodically just for preparation to pay something. And so that is what accrued and other current liabilities is. And they currently have $455 million in there. So total current assets is $714 million. Okay. Next, current liabilities. This is things that don't have to be paid in the next maybe year or 2 years, maybe 5. Usually this is where you find long-term debt on a balance sheet for a lot of companies. But as you can see here, for some reason, there's no long-term debt that Logitech has, which is actually a good thing. Doesn't mean they're debt-free, because obviously they owe some money to other companies. But long-term debt that has to be paid within the next 5 years, 10 years, like lines of credits or credit lines or things like that, they don't have any on their balance sheet, which is actually a positive thing. And I'll explain why once we get to that point. So income taxes payable. These are income taxes that maybe you have to pay within the next year. Now, it's different with every country, because I know Logitech is based in, is it Sweden? I think it's Sweden. Every company has to pay income tax, and it's based on your, the continent you lived in, the city, the country, whatever place you live, that's what that is. So they owe $40 million in that. Other non-current liabilities sits at $119 million. I'm not exactly sure what the breakdown of this number is or what that entails. I haven't looked into that. And then total liabilities is just the total of all the liabilities. So we sit at $874 million in total liabilities. Okay, shareholders' equity. How do I explain this? Shareholders' equity. So let's say we have to think worst case scenario for this. If the company goes bankrupt, what does that mean? So assets minus liabilities equals shareholders' equity. Okay, whatever's left over if the company faces bankruptcy, and that's like the worst case scenario. They have to pay out their employees, their workers, then the banks if they owe any money, and then whatever's left over, not taking income and expenses into factor, what is left over is paid to shareholders. Okay, that is what's left for the shareholders. So as you can see here, additional paid in capital, that is what that number actually represents. After workers, employees, banks, all the liabilities are paid out and everyone's paid, and everything kind of sits whatever's left over. This is what the estimate additional paid in capital is. Okay. Retained earnings. Okay. You'll typically see this on a lot of balance sheets. And the thing is, retained earnings means all the money that's left over minus the dividends. So this company does pay a dividend, but I think it's almost 1%. It's not that high, but that is what retained earnings is. Whatever's left over minus the dividends, okay? And we set that at $1.6 billion for retained earnings. So it has increased, which is great. The next thing is accumulated other comprehensive loss. This is a deficit from the previous year, okay? And so that's just what that means. Next is total shareholders' equity. So you take this, you minus the liabilities, you come up with this number here. And then pretty much total liabilities, and shareholders equity is the number that should match your total assets. Okay. So this number right here, total liabilities and shareholders equity, should match total assets up here. That is why it's called a balance sheet, because everything has to balance. Okay. So that is how you read this consolidated balance sheet. If you have any questions, like I said, a lot of these look different. You can look up the numbers on which one is which, or not the numbers, but look up which term is which. So I'm going to go ahead and share with you guys what I look for when I'm looking at the balance sheet quickly. Very simply, I just look at the total current assets, 1.4 billion, or yeah, total current assets at $1.4 billion. And I look at total current liabilities. If the company goes bankrupt today, can they cover the liabilities? Yes, I want assets to always be higher than liabilities, which it is at 1.41 billion versus the total current of 714 million in liabilities. So yes, that is all I look for on here. And I just want to make sure that assets continually grow little by little and liabilities decrease little by little. The no debt thing is a great thing because that means they don't owe the banks money. That is how, again, you guys read a balance sheet. Other than that, guys, hopefully it makes sense and hopefully I'm very thorough with it. I try to slow down a little bit. I don't know if it was a good idea, but anyways, hopefully you guys did enjoy the video. It is Friday, so enjoy the weekend and we'll see ya in the next one. Bye.